I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule, formerly of Sprott and now an investor and speculator. Before we get started, just a reminder that if you enjoyed this video, make sure you hit the like button and subscribe to our channel. Rick, thank you so much for being here online with me today.
Charlotte, it's always a pleasure. I'm delighted to be back with you.
Always great to have you here, and we're going to start off with an easy question. You recently hosted the Rule Symposium on Natural Resource Investing, which is an annual event where you bring together smart people that you think investors should hear from. To begin, can you give me a sense of the sentiment at the event on the resource sector?
Well, in fairness, this conference has gone on for 20 years and has a constituency that's pro-resource. So part of the question is like you asking at an evangelical church if the choir believed in God. To some sense, it self-selects. I think this year's crowd was sober. And I'm not making light of the fact that this was a virtual rather than physical event, so they couldn't get them drunk in Vancouver Harbor. By sober, I mean that the malaise with regards to the gold price and the retreat that we've seen in the gold equities has got more rational instincts than occurred last year when we were in a rip-roaring gold bull market. I think, too, every constituent in the conference, not just the attendees, but the gurus, if you will, the big picture thinkers, the portfolio managers and analysts, and the exhibitors too, exhibited a maturity with regards to expectation and technique that I think was useful. I particularly enjoyed in this market interviewing the people that I call the living legends, the entrepreneurs who built multi-billion-dollar companies from scratch and imparted the wisdom that they learned building these companies. Each of them said that an important, or the various facets that were important in terms of achieving success in resource investing were, first of all, a contrarian sense. You actually buy these things when they are less in favor. Tenacity, which is to say that you have to work through harder markets, and patience. They all pointed out that getting 10-to-1 returns or 21-to-1 returns doesn't happen in 90 days. You have to be prepared to wait through market cycles. You have to be prepared to let your investments mature for 5 or 6 years. And I think all of those messages resonated with an audience that has obviously had their faith in resources challenged in the past year.
In many of the conversations that I've been having, people are, a little bit disappointed to not see gold doing better. And I know when we've talked in the past, you've described it as a cyclical decline in a secular bull market. But of course, we have to get your updated thoughts on where you see gold at right now and what's going on with the price.
I'm becoming increasingly bullish in the near term on the gold price. You'll recall that I have thought at times in the past that gold, in particular the gold equities, were ahead of themselves. I find the current malaise to be a good thing, a sale, if you will, if it were occurring in physical goods. But importantly, I think that although many things impact the gold price, the most important determinant is nominal and real interest rates in US dollar terms. I noticed that last year, when the interest yield on the US 10-year Treasury declined, it had a 2.5-year decline from 300 basis points to 60 basis points, the gold price did well. When the Fed began to reduce manipulation of the long rate and allowed the US 10-year Treasury yield to go from 60 basis points to 175 basis points, the Treasury strengthened, the dollar strengthened, and gold weakened. Very recently, the yield on the US 10-year Treasury has been taken down from 170 basis points to 120 basis points at the same time that revised inflation statistics lead us to believe that the purchasing power of the US dollar is declining by 4.5% a year. So I think now that a recovery in the gold price occurs sooner rather than later. I'm always fond of saying that I like things that are inevitable but might not be imminent. I'm beginning to think that an upward move in the gold price is imminent too, as a consequence of the expansion of the negative margin on the US 10-year Treasury.
Right. And in addition to that, we have inflation becoming a growing part of the story when we talk about gold. What is your outlook there? What are you seeing in regards to inflation?
Well, I mean, the first thing that I would note, Charlotte, and I think you and I have talked about this before, the people who compile the inflation statistics don't shop where I shop. The idea that the basket of goods and services that I buy is only up by 4.5% is silly. I just built a house. Mercifully, I got the house built before the lumber price went up 350%, before the steel price went up 70%, before the gyprock prices went up 50%. If you look at the price at the pump for gasoline on either side of the border, it's up substantially. And probably the most aggravating of all to me, the fact that when they compile the CPI, which is in effect a cost of living index, it doesn't include tax. The biggest single expense that most people in North America have is their government, and the cost of government goes up every single month. So what I would suggest to you is that, first of all, the stated rate of inflation, which is 4.5% a year, is very detrimental to your financial health. What they're saying is they're going to reduce your wealth by 4.5% compounded. That means over 5 years, more than 35% of your wealth has gone to wealth heaven. But I think that 4.5% understates the rate of inflation, personally, at least in terms of the basket of goods and services that I buy.
Right. So that is a little bit scary sounding. Concerned should investors be about inflation? And if you are, for example, a resource investor, what factors should you be considering as you adjust or perhaps decide not to adjust your portfolio in this current environment?
But let's take the questions in order. If you're a saver, particularly if you're a saver involved in municipal bonds or some kind of bonds, imagine what happens to your wealth. Let's look at the US 10-year Treasury. You lend the US government money at 1.2% for 10 years in a currency that's depreciating by 5.4%, or pardon me, 4.5% a year for 10 years. But what that means is that the government absolutely guarantees you that you're going to lose 3% a year for the privilege of foregoing consumption. This is stupid. The truth is that if you are saving for retirement in any income instrument, these artificially low interest rates are destroying your retirement savings. You need to do something to fight back. Traditionally, over 1,000 years, precious metals have been a very good form of fighting back. They don't go up in linear fashion with inflation necessarily. They might lag inflation. In other words, they're a perception gauge in the near term rather than a reality gauge. But I certainly think that investors need to own some physical gold, and investors and speculators should own some well-considered gold stocks. By the well-considered gold stocks in this discussion, Charlotte, I'm not talking about the penny dreadfuls who are looking for gold, but rather the companies that have gold and will benefit from an increase in gold price. I think, too, that investors need to look at out-of-favor commodities where the producers, while they might not be in favor, are generating very strong real cash flows after sustaining capital investments. So I would encourage your Canadian constituency to look at the mid-cap Canadian oil and gas companies. It's true that your prime minister doesn't like them. It's true in your province that your provincial premier doesn't like them. But they've both proven to you that they're not going to safeguard your wealth anyway, so you don't have to listen to them. At $60 US oil quote, and particularly at $2.50 and above AECO natural gas quotes, the mid-tier Calgary companies are selling at substantial discounts to the net present value of their free cash flows and need to be considered. Two, the dividend yields associated with these companies provide you some protection against the fact that the stocks, while cheap, are unpopular.
Right. And we've spoken, in addition to oil and gas, also about agriculture as an industry to perhaps look at outside of the precious metals. Does that fit the bill here as well?
It's harder to do, and I don't know how to tell Canadian investors to participate in the agricultural space because I don't know any Canadian agricultural issuers, with the possible exception of Potash Corp, Nutrien, that is to say the fertilizer producers. In the U.S., there are some nominally public agricultural companies. I believe actually in an earlier interview, we talked about J.G. Boswell, a big land and water company. That stock has done well enough that it isn't the bargain that I described a year ago, but still it's probably an interesting long-term play. But again, it's difficult for Canadian investors to participate through listed companies in agriculture. And it may not be possible for some of your viewers to be able to afford to buy a farm in Saskatchewan or Manitoba or someplace like that.
Yeah, that might be just a little bit out of reach for some people. So, when we talk about inflation, that's of course connected to the COVID relief measures and money printing that's going on around the world, especially in the US. When we speak, I don't usually find you a very doom and gloom type of person, but we are starting to have these conversations on how can the US emerge from these circumstances that it's in right now. And I wondered how that looks to you.
We will emerge from this. I'm a long-term optimist, but we need a reckoning first, Charlotte. The measures that have been taken by the US political class and the US Fed are politically popular, but they're extremely dangerous. We have a circumstance where society is confusing two different words in English. One is liquidity, which we have too much of. The other is solvency, which we don't have at all. I don't know the relevant Canadian numbers, but in the United States, our on-balance sheet liabilities exceed $28 trillion, $22 trillion net. Our off-balance sheet liabilities are even more troubling. The net present value of our stipulated political obligations to each other, Medicare, Medicaid, Social Security, things like that, exceed $120 trillion. So at the federal level, Americans owe each other $150 trillion. There's no way that this can be paid. It just cannot be paid. In particular, it can't be paid with a budget that's in deficit $4 trillion a year. But rather than climbing out of the hole, we're digging the hole deeper. But the measures that got us in the hole are extremely, extremely popular. Nobody wants a reckoning, but we have to have a reckoning. Now, I believe that the US over time will get out of this, and they'll do it three ways. The first way is that they will eventually curtail government expenditures. There will be a political pushback, just like the pushback that brought Reagan into office. You'll note that he didn't decrease government spending, he just reduced the pace of increase. The other thing that we will do is inflate away the net present value of the obligations. In other words, we'll have $150 trillion in obligations, but the net present value of that $150 trillion will be cut in half by inflation. So the obligation that we have will be paid back in less relevant dollars. The third thing that needs to happen, Charlotte, is going to be ugly. And that is that we need a massive rollback of entitlements. What entitlements really are is an income transfer from your generation, younger, less wealthy people, to my generation, older, more wealthy people. And your generation has to have the political will to say to us, you guys voted yourself all these cool benefits, but you forgot to pay for them. If you want them, you pay for them, because we're not gonna. You're gonna have to begin by means testing a whole range of benefits. The idea that some old, fat, bald, rich guy like me gets his Social Security payment, irrespective of the fact that the premium was stolen from me over 45 years. Society needs to say to me, too bad, so sad. You're not going to get it. Strong letter to follow. And those are going to be really, really, really ugly political fights, because voters on both sides of the border believe that they are entitled to steal from each other via taxation. And the ability to continue to do that, that is to say, the perception of needs greatly outpaces the ability, the means that we have to sustain those needs. And so the political way out is going to have to be really, really, really ugly. I think it'll occur. I think the process will be interesting, if gut-wrenching.
Right. So, not actually so gloom and doom for you.
It's
I
not
want
doom and
to,
gloom, Charlotte.
yeah.
I really want to make this point. So often in hard money channels, what seems to get viewers is the world's going to end on Thursday. Here's
Hmm.
how you can profit. That's ridiculous. Um, I went through another pretty interesting bout in my life in the 1970s. We had the war in Vietnam, we had riots in the streets, we had inflation that reached 17%. It was severe, but we survived it. The ongoing truth is, as Churchill said with regards to the United States, the Americans always do the right thing when they've exhausted every other available opportunity. And I suspect that happens over 20 years. It's going to be an interesting process. But the thing that your listeners, particularly your young listeners, really, really, really need to remember is that individually, as humans, our genius, our tenacity, our work ethic means that we generate wealth as individuals faster than we destroy it as a collective by voting. 6 young people get together in a garage in Sunnyvale, California, out pops Google. And I am a continued believer in the ascent of humankind. I just think that there's going to be, 10 fairly rough years between here and there.
Okay, well, on that note, I'm going to shift us over to another topic, which is uranium. We haven't had a chance to speak about this in a little while, and I want to catch up with you on that one. Uranium is another market where we hear constantly that the fundamentals are looking good, and then we've kind of failed to see very much movement. So, to start off, what do you think we're waiting for in uranium at the moment?
The same thing that we were waiting for 2 years ago when you and I talked, which is the uh, restarts of the Japanese reactor fleet. Everything else is in place. You'll recall at that point in time, I said it might take a year and a half. Well, I was wrong. It's taken 2 years. The outlook for uranium is, I think, particularly attractive today in really 3 regards. First of all, the worldwide consumption of uranium exceeds the worldwide consumption of uranium before the Japanese shutdown. In other words, we use more uranium now than we did then. The second is that the increasing hue and cry about carbon, the need for increased electrification that doesn't generate carbon, has given the Japanese government the political cover it needs to begin to restart reactors in Japan, as well as casting uranium in a new light among younger voters and investors, your generation, worldwide. It's suddenly in certain circles a green fuel, which I never thought would happen. Importantly, too, in the last 2 years, we've burned up a lot of uranium. We use more than we mine right now. So we've used up the above ground inventory. And talking my book, Charlotte, I need to say that my former employer, Sprott, where I'm still, I believe, the largest shareholder, has taken over the management contract of Uranium Participation Corp. We have changed it from a corporation to a trust to make it more tax efficient for US taxpayers. And Sprott hopes to list it on the New York Stock Exchange. If they are able to do that, I think that they will be able to introduce that product to the 250,000 investors who own Sprott's physical products, the gold product and the silver product. And I suspect that they will see fairly massive inflows into the Sprott Physical Uranium Trust, which will lead to them buying fairly massive amounts of uranium. And my suspicion is that Sprott will almost by itself be able to tighten up the physical market. I believe that the catalyst is in place over the next 6 months to mop up any surplus uranium in the spot market, which will drive consumers of uranium into the term market. And the strength in the term market will be what allows the fortunes of the larger producers to increase. Charlotte, I need to caveat this because the shares of the junior uranium companies have uniformly doubled and tripled in the last 2 years. And I consider them to be less attractive investments now, much less than the last time you and I talked. You'll recall the last time you and I talked, I was fairly bullish on the juniors. Maybe as a consequence of me talking too much, the shares of the juniors have done extraordinarily well, particularly when compared to the uranium price. So I think that speculators need to use caution when considering the juniors, perhaps even going so far as to confine their buying to the much larger companies, or perhaps, again, talking my book, to the Sprott Physical Uranium Trust. I think the juniors are substantially ahead of themselves. This doesn't mean that they don't have upside when the price of uranium crests through $50 or $60, which I suspect it will. I am just suggesting that among the juniors, there's downside as well as upside now.
Right. So you've hit on a few things that I was going to ask about. So I'm going to backtrack a little bit to maybe get a little bit more insight on a few of those things. First, the Sprott Physical Uranium Trust. A lot of people have gotten very excited about that. I was going to ask if you think that it will have the impact that people hope it will. It sounds like yes. We also have the element of uranium companies actually coming into the market to buy physical uranium. So maybe we can cover that as well and get your thoughts there.
Uh, Two things. There's no guarantee that Sprott will be successful in marketing the uranium narrative to its existing investor base, given that the existing investor base is much more precious metals oriented. But you'll note that our physical precious metals products have assets under management which exceed $15 billion. If we were able to mobilize a tenth of that, $1.5 billion, which I suspect that we'll be able to do, contingent on us getting a New York Stock Exchange listing, which I also think we'll be able to do, but emphasize the word think. Then let me say this. I think it's a probability, but not a certainty, that Sprott will be successful in that endeavor. And that definition, my definition of that success, would involve an increase in AUM of $1 billion US, and that billion US dollars applied into the physical uranium market at $32 or $33 a pound would certainly make a big difference. I think it's much more likely than not to occur.
All right. And you mentioned the uranium juniors getting ahead of themselves right now. So if you're an investor who has not listened and has not managed yet to get into uranium, does that mean that it's the producers that you should perhaps be considering at this moment?
Certainly, I consider the producers to be relatively more attractive. I've been pretty aggressively on record saying that my favorites in order of attractiveness are Kazatomprom, the big Kazakhstan producer listed on London, China General Nuclear, listed on Hong Kong, and Cameco in that order. Some of your listeners may object that they can't buy British or Hong Kong stocks. I would suggest to them that they get a better broker, because increasingly you have to invest around the world to be a success. Many speculators have been attracted to at least my uranium narrative because of the lurid stories I'm able to tell about the price performance of the uranium juniors in the 2000 market. I recall at the beginning of that market that there were 5 junior uranium companies, the worst performer of which was up 22 to 1. The critical difference is that we began with market caps in those days, like Paladin, of 2 million Australian dollars. It is very, very difficult to get 1,000 to 1 move or a 10,000 to 1 move like we got in Paladin, starting with much higher market caps today. So people need to understand that the market capitalizations that are in place today almost preclude the same percentage gains that we enjoyed in those days. So I'm in an odd place. I think that 2 or 3 years from now, the uranium price will be above $60 a share. And my suspicion is that we will be confronted with at least the best 10 or 12 uranium juniors tripling or maybe even quintupling over 3 years. But I suggest that speculators might have to suffer through a 40% decline first. And while most of your listeners would probably describe themselves as long-term investors with a plan, I remember the great Mike Tyson quote that everybody had a fight plan until he hit him in the head. And the investors who are salivating at the prospect of a 5-year triple might consider how they'd feel if they suffered a 30 or 40% decline first.
All right. And speaking a little bit more about the price, we often hear about an incentive price for new production to come online. It used to be $50. Now we're hearing more like $60. Does that sound right to you? What do you think there?
It does, because I believe that the incentive price has to take into account prior year write-downs. And the uranium industry has taken massive write-downs of their assets. That doesn't reflect operating costs. Companies like Cameco, and in particular Kazatomprom, can generate some free cash flow at 30 and lots of free cash flow at 40. But there are lots of producers around the world that are generating substantial losses, operating losses, and won't generate losses till 40. Too often, investors forget that there's a cost of capital involved too. And companies need to be able to cover more than operating costs and management salaries. They need to be able to cover the cost of capital. And I would suggest to you that the fully loaded cost of uranium, including prior year write-downs, management and general administrative expense, and importantly, cost of capital, is probably in the range of $60 a pound.
Those are the issues that I wanted to cover today. Before we wrap up, just want to ask you if you have any final thoughts that you would leave investors with as we head into the rest of the summer.
Well, particularly Canadian investors, I want to reiterate that your own oil and gas sector is attractive. Not the real juniors, but the sort of mid-caps, the mid-caps that are generating strong free cash flow and have the ability to redeploy it. If you have courage, which I do, I think the Canadian natural gas sector, which has been hated for 10 years, is particularly attractive. So I would urge Canadian speculators and US speculators too to look long and hard at Calgary. I think there's some relatively easy money to be made there, and easy money is rare. Finally, I would urge, as I have in past interviews, Charlotte, that if your listeners or viewers are interested in my opinion on resources, I would urge them to go to a website, sprottUSA.com/rankings. When you go there, you can list your natural resource stocks at that website. Please no crypto, please no pot stocks, please no technology. I will rank those stocks 1 to 10, 1 being most attractive, 10 being least attractive, and comment on individual issues where I think my comments might have value. I like to talk to your listeners, and I encourage them by way of this free ranking service to do so.
Perfect. And as usual, we'll leave that link in the video description as well so people could find it easily. Thank you so much for being here to talk about what's going on in the resource space.
Charlotte, we're coming back to Vancouver with the conference next year, and so we look forward to seeing you both in person and virtually at that conference.
Very exciting. Hope to see you there.
Great.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule.